Your Excellencies, distinguished guests, dear friends, ladies and gentlemen. It's a pleasure and privilege for me to welcome you all for this interesting and exciting session. Today is also an important day for us to celebrate. We opened our representative office in Sharjah to cover the Northern Emirates. Doha Bank has been, thank you, has been a sustainable performer with a boom or downturn, sustaining its credibility as a best performing institution is what we committed as a mission. The committed vision of my board, professional execution of my management team, participative in substance, has been the success story for us to be proud of the fraternity which we are building in. It has scored in all dimensions, socially committed as a green bank, professionally responding to knowledge society building, and again, best performing ratios in terms of, given the size of the shareholders' money, produced outstanding results in terms of return on average equity. Given the size of the balance sheet, again, return on assets. Shareholders' money, highest return, shareholders' money being deployed in the right asset allocation model to sustain as a best performer. We have committed vision to globalize. The principle-centered meaning is quite simple. It was in 2002, the globalization was on, deregulation was on, technology was converging, and consumerism visibly shaking up the global space. When the local market has become global, we said we will go global. That's precisely the reason we set in footprints today, world over, expanding. Wherever Qatar and the Gulf states have got economic linkage, we are there. It starts with first representative office we set apart from Qatar. We have 55 branches today. It was representative office, we set it up in 2004. We converted into a full-scale operation in 2008. We have a second office commission way back in 2006 in Singapore during the IMF International Monetary Fund meeting. The governor of the Central Bank of Qatar has inaugurated. And again, it is Tokyo in 2006, Istanbul in 2006, 2007 was Shanghai, and again 2008 was South Korea, 2010 was Frankfurt, thereafter London, then this year we have switched on in Sydney, Australia, Toronto last month, October 16th, today, Hong Kong plus Sharjah is our committed footprints for us to support the global trade, investment in banking and finance. Coming to the specifics of today's content. With the changing face of the world, with the changing face of the financial service, new world order setting, reorganization, and global transformation in substance. I was in Washington last month on the International Monetary Fund meeting. It was contentious for us to see whether world is still, global growth is still, is on or not. The universal standard we sit in terms of accounting, valuation, securitizations, needs to be executed. G7 has become G8, G8 has become G20 today. Politics and economics still needs convergence in substance. And that's what the world we are in. Financial economies are still reeling under pressure. Real economies are redefining their scope and performance. We live in an interconnected, interdependent world. Look at the IMF economic outlook. The global growth still less than 3%. It has been revised downward to 2.9%. Advanced economies still grossly underperforming. US tapering, that is, what has changed in the last 5 years is the liquidity. Liquidity has moved to funding crisis. Funding has become sovereign crisis. It has become a solvency issue for nations, continents. That's why we have seen Greece, Portugal, or Italy, when the gross debt to GDP is outside the line, and fiscal consolidation is needed the hour. If you look at the American substance, you have major challenges still to overcome. There are conditions which are mutually inclusive. making sure housing market has a sustainable recovery, ensuring consumer price inflation coming to terms, not less than 2%. Unemployment is contained to 6.5%. These conditions are mutually inclusive. Then, so-called the quantitative easing programs, printing money, improving the liquidity, has inflated the stock market. Then, it has reflected, transcended borders, world over, hot money was swinging across. That's why you have seen reflection across the globe in the stock market. To taper that, to reduce the bond buying programs is an issue. Unless you have solid economic fundamentals, you cannot do that. Open market operations, everyone has tried. America has tried, not only QE1, QE2, QE3, that has stimulated the market and intensively, again, inflating the stock market. EU has got a different spell of problems. Monetary policy is centralized, fiscal policy is still not centralized. You need a fiscal union, you need banking union, you need to make sure the criteria which were set in terms of Maastricht Treaty, gross state to GDP, deficit financing, should all be observed in the enlarged Europe. That's a difficult value proposition. It's a cultural makeup which needs convergence in addition to economics. When it comes to emerging markets, which are all coasting along very well, China has done 30 consecutive years, not less than 9%. India has done over 14 years, not less than 7%. Today is decelerating. Today it is slowing in its momentum. I was in China on 19th of July, when the second quarter economic turnout was just 7.5%. World over, there were concerns expressed. India, as a functional democracy, is going through similar spells. When Federal Reserve was pronouncing in June 19th this year, there's a possibility of cutting down the bond buying programs. You have seen the reflection world over in the emerging markets. Currencies were absolutely in tandem going down. They were weakening and dollar was strengthening. The result you could see, extraordinary downturn in terms of growth prospects. That has destabilized the overall currency market. What happens when the currency gets weakened? It has got a reflection in the trade. You purposefully, as an accommodative monetary tool, you weaken the currency. That's what we have done in Japan. By this time last year, Abenomics was invented. Open market operation of trillions of yen was put into place. That has weakened the overall currency, and dollar index was having similar spell. Reflection, Japanese could export more. The economic recovery was in prospects, and Japan, Nikkei, you should clearly see it's over 40% up today. Currency war creates trade war. That's the substance. When you weaken the currency, people also hedge the risk by buying commodity futures that inflate the commodity prices. We have seen reflection in the oil price. Today, Brent is quoting 106, and WTI New Max is quoting $90 to $93. That's not an ordinary spell. These are changes which needs commitments. In terms of global governance, G7 has become G20 today. These decisions, which have been spelled out in multiple meetings, London, Pittsburgh, and again, St. Petersburg, a couple of months before, needs to be executed. You need to fix the tax havens. There's nothing as offshore. You need to fix the tax avoidance. Trillions of dollars have been defrauded. Money has been hoarded as a parallel system world over. Those needs to be brought in transparent terms. Those changes are pure conversion of financial economies, financial engineering to real economies. Those changes are not ordinary changes. Those decisions needs absolute political will, and scientifically we need to accommodate the monetary policy as well as fiscal prudence. That's not easy. That's not easy. If you look at the different spell of financial stability which we are witnessing in the Gulf states, it is commendable. We are insulated in terms of macroeconomic fundamentals. We are not isolated from the global financial crisis. Look at taking oil at $75 today. This is $1 trillion block, 1.6 trillion to be precise. Topping in the list is Saudi Arabia with $720 billion. Then comes UAE, $390 billion. Then comes Qatar, a small country with 11,943 square kilometers. Today is having commendable financial stability, costing over 200 billion as the GDP, over 30% as the current account surplus. Nearly 55 to 60 billion is what we generate as current account surplus. And again, the rest of the states like Kuwait is producing 186 billion, taking oil at 75, and Oman is 72 billion, and Bahrain is 24 billion. Summing it up, it is clear, 1.6 billion. As a percentage of gross debt to GDP, you clearly see we are under control. We are all running in current account surplus. Current account surplus is over 20% en bloc for 6 states. And again, fiscal surplus, that is investable surplus, if you look at it, it's 7 to 8% in aggregate. That's not ordinary financial stability. If you look at the states, these states have now, in the last 1 year alone, if you look at the budget, perhaps the social progression has been visibly showcased now with the Arab Spring in the making. Healthcare and education projects in terms of urban development, airport, seaport, road, rail, network, everything is accelerated. That's precisely the reason every finance minister is showcasing considerable amount of government expenditure. That drives the change. Last year alone, 6 states put together $377 billion of expenditure was committed. Again, topping the list is Saudi Arabia, 121 billion. 116 billion is from Kuwait, 69 billion from UAE, 45 billion from Qatar, 24 billion from Oman, 8 billion from Bahrain. Summing it up again, it shows 377 billion. That's the kind of development expenditure is going to drive the change. We are expecting 2020 announcement in UAE. We have got the announcement done as far as FIFA is concerned, 2022. This is going to revitalize the space. There are huge amount of urban development, modernization. That is going to stimulate the market. What does it mean to the global trade? If you look at the global growth versus global trade, we have many things to be worried about. In normal terms, double the GDP should be the aggregate global trade. That's not what has happened in the last 2 years. It was 5.2% in 2011. It was 2% growth in 2012. There is a deceleration in substance. That's not a good story. Even after weakening the currency, creating a currency war, trade is not going through purely because austerity and value creations are mutually exclusive. The governments who have lived, individuals or institutions, countries or continents who have lived beyond their means, they have to come to terms in containing the expenses. When you start containing the expenses, when you don't have development expenditure, you don't have growth. You don't have growth, you don't have employment. And that's a dichotomy. Look at the budget resolutions, which is contentious in the United States itself. The entire IMF meeting was confined to political disarray. Whether the enhanced limits will come, whether the government could sustain its credibility as a AAA rated nation was the subject of discussions in IMF. That was very contentious. $16 trillion economy getting into the doldrum is not an ordinary phenomenon. That's the world we're in. That's not an ordinary situation. These are defining moments to convert the financial economies into real economies. Real economies like India, going through extraordinary current account deficit. And again, there's a possibility of fiscal consolidation which needs strong policy makeups. Politics and economics have to converge again. These are not stories. These are not fictions. These are absolute facts. How do we improve the trade? How do we accelerate the trade? Look at the trade growth. Developed economies are just doing less than 2% in aggregate terms. Developing economies, who are costing not less than 4.6% as en bloc growth, they're producing between 4.4 to 4.8 export-import put together in average terms. That's not good. If you look at the UAE economy in particular, it's still going well. It was in 2009 in October when we had contentious property market downturn. I was in BBC. I was in CNBC. People thought Dubai story is fault. I was in CNBC. It was very contentious, 20 minutes interview. It is in my website. Perhaps you can have a look at it. Have a look at it. It was contentious for me to showcase the total gross debt to GDP in terms of UAE as a nation is measurable, manageable, controllable. Property was overextended, but same time, it will bounce back with the vision ahead of time. That was my statement. Today, Dubai is bouncing back. Dubai is coming to terms. Extraordinary transformation. We could see clearly, sitting as in a bank, debts are getting restructured. Rating agencies have put faith back in track. And again, we are seeing the symptoms of cash flows and liquidities surmounting to substance. And we are also seeing income, rental incomes are improving. It shows clear transformation. The road ahead is really interesting and exciting. The projects which we set in as a committed vision for all these states is going to stimulate the local market. We have seen the reflection last year itself. If you look at UAE trade, in terms of India, it's 75 billion, topping in the list, bilateral. UAE versus India was 75 billion. UAE versus China was 50 billion. UAE was Japan was again 50 billion. UAE was Singapore was 25 billion. UAE was Turkey, again, it's 12 billion. I can go on. South Korea again, over 21 billion bilateral trade. In form and substance, UAE is moving in the right direction. GCC is moving in the right direction. But we need to understand the variances. We need to understand the nuances of the trade. We need to make sure we understand the risk as well as the return and integral. That's precisely the reason today we have coined this session. With me, a light panel full of extraordinary contents. To join me, we have fine legal firms, Al Tamimi, Katie Law, and again, a lady representation is very much there. And we do have Euler Homes to show what sort of risk cover we can profile. Mapping the risk is very important. Risk is measurable. Any form of business you have risk, that needs to be mapped as integral part of your overall functional makeup in terms of business modeling. And that's what we need to understand. Macquarie Bank is going to showcase the structured trade finance. What sort of realignment required in terms of understanding the conceptual frame of trade with the changing face of the market, with the changing face of the global framework. And again, we also have to understand the overall dynamics of the trade flows. To add value to this content, we have this elite panel. Ladies and gentlemen, at this juncture, I would like to showcase my global representations. Today we had the annual summit of international managers meet in Dubai. I would like to stand up. I'll request my colleagues to stand up and showcase their presence actually in the hall. To start with, I represent Doha and the whole world, global terms. But I have a UAE representative here. To start with, UAE, Dubai branch, Mr. Nail. Here we go. Abu Dhabi, Mr. Purdos. China, Shanghai, Mr. Peter Lu. There you go. Can you focus on the lights, please, there? Hong Kong, the new office we opened on 30th of last month. We have Mr. Ivan managing the China and Hong Kong office. Singapore, Mr. Satyamurthy, we opened in 2006. It's a terrific success. We do have representation from Kuwait. Unfortunately, has not been here. We have full-scale operation in Kuwait in 2008. We opened our office. Unfortunately, he couldn't join. Moving on to Sydney, Mr. Hilton. There we go. Tokyo, Mr. Kanji. We opened our office in 2006. South Korea, Mr. Kwon. That's a brilliant relationship for the Gulf. Istanbul, Mr. Nezi. Frankfurt, Mr. Mike. And the last but not least today, Sharjah, Krishna Kumar. Is he there? Here we go. Heading the team today, adding to the list is Mr. Ganeshan from head office, heading international banking. Ladies and gentlemen, it's a pleasure and privilege for me to welcome once again. I'm sure you will. Canada. Oh, how can I forget Canada? 16th of October, we opened our office in North America. That's interesting. That's interesting. Here is Tony Sekera from Canada. Canadian trade is improving still. That's the reason why. It's still, you're doing $2 billion. You have to do more to UAE. Ladies and gentlemen, it's a pleasure and privilege to welcome you once again. London, Richard. Too many names for me to remember. By this time next year, I'll forget the total list now, I believe. Thank you one and all for your kind listening.